Good morning, everyone. I'm Millie Hong, Head of Events at Asifma. Thank you very much for joining us today at this virtual event, U.S. Support Programs for the Markets and Economy. Let me introduce our host today, Mr. Mark Austin, CEO of Asifma. Mark, over to you, please.
Thank you very much, Millie. I'm really happy to have you all here today. I'm very excited that I have some of my colleagues in SIFMA who will be talking about the many US support programs for the markets and the economy and what that has meant so far for the markets as well as the economy and what we can expect going forward as we navigate through this crisis. Maybe just before doing so, introducing them, I'd just like to mention a couple of housekeeping points. The first one being that throughout the course of today's webinar, which will be about for an hour, you're more than welcome to ask questions. There's a Q&A box, as you'll see at the bottom. Just click on that and ask questions, and I'll look as best as I can to ask the two panelists to answer those questions. So without any further ado, I'm going to introduce, so Carter McDowell is Managing Director, Associate General Counsel of SIFMA. And then we also have Robert Toomey, Managing Director, as well as Associate General Counsel for Rates for SIFMA. So I'm going to kick off by handing over to Carter, who's going to lead us into this. So Carter, over to you.
Thanks, Mark, and thanks for having Rob and I. And I've been out there to your place, and I hope everybody's doing well. And what we thought we'd do is give a little bit of background before we jumped into the questions that Mark has asked for us. And I think the best place to start is with what's going on with the virus, because it really does sort of inform everything that's going on in the financial system and the economy generally. So, and I'm also concerned because when I've been out in Hong Kong and Asia, your news tends to be from the New York Times and CNN, which is a very New York-centric, focused view of what's going on in the United States. And so, you know, let me talk about that for a little bit. So if you look at the where we are in the crisis, we've obviously got the most number of cases, and I think we've got the most number of deaths, but they've been doing some analysis, and we did a very early travel ban from China, and that seemed to have worked. We did that back in January, but we didn't stop travel from Europe. And now with genetic testing, it's looking like the virus sort of came to the United States through Europe because we didn't stop travel there. And so hence, the virus is hitting the East Coast much harder than it is hitting the West Coast. And it is hitting the New York metropolitan area is sort of the epicenter of the crisis in the United States because it has two of the major international gateway airports for people coming from Europe. So it's sort of understandable. And if you look at the numbers, the metropolitan New York area is responsible for about a third to 40% of the cases and the deaths in the United States. And the other big places where it's hitting, so that's not just, you know, lower New York State and the city of New York, it's also suburban New Jersey, suburban Connecticut, and then it sort of bleeds into, you know, the East Coast cities of Boston, Philadelphia, down to Washington, that kind of stuff. But it's not hitting the West Coast or the South, Texas, Florida, nearly as much as it is hitting the rest of the country. And so you also, when you think about our economy, which at the end of last year was a little bit north of $20 trillion a year. New York is certainly an engine of the economy, but it's not the whole economy. And so you need to sort of look at what's going on by state and by region. And we have some states that really haven't been affected at all. And so I would say that we're in the early stages of reopening the economy, which has been shut down for about 2 months. We have some states that never shut. We had some that only partially shut, but most places are either in phase 1 or phase 2 of what will be a 4-phase process for opening the economy back up. The other thing that's really important about this crisis, and I think that'll have a big impact on the reopening, is that analysis is also showing that depending on where you are, between 40 and 60% of the deaths that are occurring because of the virus are happening in nursing homes and assisted living facilities. And so it is really hitting the old and the retired much harder than it is hitting the rest of the population. After nursing homes and assisted living, the next largest categories where the virus is spreading are hospitals, which you would expect because they're dealing with the crisis, and then actually the prison or penal system, where you've got people in really tight quarters. The other thing is that you also can't look at the Fed programs, which you've asked us to look at, without also understanding that there's been enormous, unprecedented fiscal stimulus enacted by Congress, which has been going along with the stimulus that the Fed has put in place. So I wanted to give you a little flavor of what's been going on there. The Congress has passed 4 stimulus bills, and they are probably working on a 5th, and they have pumped essentially $3 trillion into the economy. So again, if we're a $20 trillion economy, the $3 trillion that the Congress has pumped in, plus Rob and I will talk about another $3 trillion that the Federal Reserve has pumped into the system, you're looking at, somewhere around 30% of the economy is sort of being carried by the Fed and the federal government right now. And the thought was that this was a self-imposed crisis. We were, voluntarily shutting down the economy in order to flatten the curve and prevent overwhelming the hospital system. And so the idea was always that this was never going to be a long-term problem, but rather a short-term one. And so the stimulus was, I have to give Congress, you hear a lot about the dysfunction in Washington. With all of the stimulus, they've actually worked very well together on a bipartisan basis. And they've really put a lot of money into the hands of the people most impacted by the shutdown. So let's start with right now, as of the end of last week, we had unemployment in the United States of about 24%. We had begun back in February with unemployment at 3%. So that's just an enormous increase. But one of the things that Congress did was realizing that by shutting the economy, it was going to furlough a bunch of workers, cause a bunch of unemployment. They've given a weekly top off of an extra $600 to people on top of whatever unemployment benefits they get from their state or local government. And in most cases, that, not most, but I would say at about 40% of the cases, people are actually making more money on unemployment than they were making at their jobs, because most of the jobs that were laid off and furloughed have been in low paying jobs, about 40% of the unemployment. If you think about what's been hit hardest, it's restaurants, bars, gyms, the arts, that kind of thing. That's where most of the unemployment has been. So the thought was that that extra $600 a week will continue through July. The hope was that the lockdown will not last that long, but that this will, tide people over so that you're sort of pumping liquidity into the system and avoiding a credit problem in this temporary shutdown. The next thing they did is for people that are still working and working from home mostly, they gave them a one-time stimulus check of $1,200 each, plus an additional $500 for each minor child that you have. So again, there was money pumped into consumers' hands so that they wouldn't have to miss a mortgage payment or a credit card payment and still be able to buy food and live. They also used some of the stimulus money in a grant program for small businesses so that if they retained workers on their payroll and maintained their health insurance, they were eligible to receive a grant from the government. And if they maintained 80% of their payroll, the grant would be forgiven. And so there wouldn't need to be any payback. And then, of course, the Congress gave money for vaccine research and to help the hospital system and, kind of critical care folks. But, a lot of liquidity pumped in. And so at Asifma, we think about what we've been going through as sort of a two-stage process. And we're probably in the middle, or the transition between the two stages. We would describe that what happened in March and April was essentially a liquidity crisis, where people were reacting to the shutdown of the economy, the spread of the virus, the increase in sickness and death and that kind of thing. And people were moving to cash. They were trying to get their house in order and prepare. And then the Congress dumped the stimulus into the economy, and that the idea is that will help tide them over. I think we're coming to the end of that. As I said, we're opening up the economy. Those stimulus payments will, in some cases, continue until July, but they will begin to peter out. And so now we're sort of entering a phase which is the recovery. I'd like to phrase it as a recovery, but it could include a recessionary component. I mean, we've certainly, the numbers with 24% unemployment and the possibility of the economy contracting 5% in the first quarter and another 5 to 8% in the second, sounds really ominous. But I think that the feeling is that the economy, while it might not have a V-shaped recovery, so it might not bounce back, that with all of this stimulus, the recovery will be boosted by what has been done. And so last week I attended an event where Gorman, the head of Morgan Stanley, was speaking with some professors from the Harvard University. And they were speculating that while unemployment is at 24% right now, they thought that it was reasonable to expect that by the end of the summer, the unemployment rate could drop to 12%, because a lot of the people that are unemployed are furloughed. They were employed by businesses that are shut, and as those businesses reopen, they will be called back to work. And so the unemployment rate will drop from this high. It will not return immediately to where it was in February, and getting from 12 back down to 3 will sort of be a slog. But the feeling is you might see some dramatic decreases in the unemployment rate. And then in the fall, this may begin to look more like a normal recession, where people that haven't gotten jobs or businesses that have failed, because of the crisis, that will begin to look more like a traditional recession. And we are seeing some of that. We're seeing some retailers that are filing for bankruptcy. Generally, in the United States, we have very robust bankruptcy laws, and a lot of it happens in a reorganization. So essentially the creditors take a hit, but the business doesn't actually cease to operate. It just reorganizes its debt. But you are going to see some businesses shuttered. And so there will be some dislocation there. And so I'm trying to make sure I covered all of my points. And so I guess where I would leave it is that this fiscal stimulus, we really do think has sort of acted as a bridge or a delay in the depth or severity of whatever economic turmoil we've got coming. Because what we're seeing in the financial system is people are not missing their mortgage or rent payments. We're not seeing huge spikes. And so the financial system is using this interim period to really bulk up its loan loss reserves. Another thing that's happened in the United States is 70% of capital distributions for the financial services sector happen in stock buybacks, and only 30% happens in the form of dividends. And all of the financial services firms have voluntarily stopped stock buybacks. So they are conserving capital. They are using that to, as I said, increase loan loss reserves. And they are, if standing by, if need be, to take dividend action. Another thing that I should have mentioned that was it wasn't fiscal stimulus and it's not monetary stimulus, but it's having a big impact. In the United States, Rob may know the exact figure, but I would say somewhere around 70% of mortgages are backed by a federal guarantee, by Fannie Mae, Freddie Mac, Ginnie Mae, that kind of thing. And those federal agencies have asked the financial services sector to allow for mortgage forbearance for people that have been negatively impacted by COVID-19. And so what will happen for those folks is it's a very simple procedure. You just basically alert your mortgage lender that you've been negatively impacted by the virus. They can suspend your payments on your mortgage for up to 12 months so that will give you some financial relief in this interim period. And then those payments will simply be rolled into your mortgage balance and amortized over the remaining period of your loan, so that the lenders and the securitizers, the people that own the securitized products won't take losses, although they may need some temporary liquidity in the interim. And then just to sort of tee up, Rob, and I'm going to hand it over to you now, Rob. One of the questions that Mark asked was, has the Fed shot all its bullets? Have they used up all their ammunition and that kind of stuff? And one thing that is abundantly clear is they are not out of bullets. They've signaled over and over again that they are willing to stand by the economy and do whatever it takes. And I would add to that I think both the Democrats and the Republicans in Congress stand ready to do the same thing. So we are probably looking at another stimulus bill. That bill will probably have a couple of components. One that the Republicans want, which is a huge infrastructure component so that it puts people back to work, so that you work on unemployment. And the Democrats will want some assistance for the states who are taking huge budget hits as a result of lost sales tax and income tax revenue because of the shutdown of the economy. And so what you'll see is probably some of that being federalized at the national level by Congress assuming that debt. There's a long history of that in the United States, going back to Alexander Hamilton when he nationalized the debt of the states to pay for the revolution. So, I would imagine that will happen. So that's sort of my background setup. And Rob, take it away.
Yeah, Carter, thanks a lot. I mean, maybe just before I hand over to Rob, I mean, excellent background on where the U.S. is, and I think it's not something that's necessarily commonly understood here. There are a couple of questions around the stock market, but maybe I'll leave those until Rob has a go at the program. So over to you, Rob. I assume socialism's alive and well in the United States, it seems.
We do have an election coming up.
Well, thank you, Mark, and thanks, Carter. And just to sort of, and Carter kind of highlighted in his intro the fiscal side and how, the Congress is infusing a massive amount of money into the economy. It's $3 trillion and growing. It will be more, but also and now what we'll talk about is what the Fed has been doing to infuse liquidity into the financial markets in particular. And they have moved massively and fast. And I'm going to take a bit of a historical view, and historical, we're only going back 2 months, but a view of what the Fed has done and how it has developed its programs, as things changed on the ground. And I'll give you some dates as we go through. And one of the reasons I'm going to give dates is they're important. So you lived through it, I suspect, and you'll remember how fast things happened. And it also, at least from where I sit, how fast the Fed was able to react fast to different parts of the market that were showing stresses through the various programs. And we'll take you through some of the, at least some of the high high-profile programs that the Fed's put in place to address some of these concerns in the various markets. But first off, going back to March and going back to the first couple weeks in March in the U.S., early on, you started to see some stresses in the U.S. repo market. Now, the repo market is, not spoken of a lot, and that's good, but it's very much the plumbing and the underlying plumbing of the entire financial system. And in particular for the U.S. Treasury market, and it provides liquidity for the Treasury market. It has an overnight turnover of somewhere in the order between 2, 3, 4 trillion, depending on how you measure it and who measures it. So it's a very large market, very liquid. Generally, it operates without a problem, but it was beginning to show stresses in the first 2 weeks of March. In March 3rd, I believe, or March 4th, the Fed lowered its target rate, its Fed funds rate, for the first time in the first 2 weeks of March. And what was happening was, and the Fed funds target, the policy rate that the Fed targets, it's the overnight rate that banks charge to trade reserves. But it's a range. And the repo rate, the general repo rate, trades usually inside that range, probably right down the middle. What was happening was it was getting at the very much high end of the range. And the Fed, wanting to support its target policy rate, and this was before it had become clear that what was happening was a massive move and hoarding of US dollar liquidity, which is what was affecting the repo market. The New York Fed operated to really ramp up its backstop of the repo market. Here's where the dates start coming in. March 11th, the Fed announced a daily $175 billion overnight repo operation with the primary dealer community, which is massive. At the time, it was a very big number. As well, they were going to operate in the term market, which they usually didn't do, at a level of about 45 billion a week, which is a much smaller number. However, and that helped. It helped that day, and it eased stresses. The following day, though, there were new stresses started to appear, and particularly in the longer end repo. Overnight repo seemed okay. So what happens on March 12th, the Fed announces for that day, a $500 billion repo operation, 3-month repo operation. And then they further announced on the 12th that they were going to do this for the next 3 days, offer $500 billion a day in 3-month financing, taking Treasury collateral in repo. And then they were going to do these $500 billion operations weekly going forward. So this was massive, and I deal a lot with, and I talk a lot to the repo traders, and this is great because it essentially backstopped the repo market. And the repo market then, quite frankly, calmed down and started to behave as it normally does. The overnight rate was sort of floating in the the middle range of the Fed funds target. Then start looking at the Treasury market at the end of this period being March 11th, March 12th, into March 13th, you started to seeing some real anomalous behavior. The Treasury market, as you all are aware, is the deepest, most liquid market of securities in the world. And what was happening was, particularly in, first off, some of the less liquid sectors of the Treasury market, the off the runs, they were showing extreme stress, liquidity stress. But then also, and this is what was most significant, the longer tenor, even on the runs, the 30-year and then down to the 10-year Treasury notes were showing liquidity stresses. And this was very surprising. There was a one-day, I forget exactly what the number was, but a massive spike in the repo rate for the 30-year and for the 10-year. And so as a result, and this was as a, the Treasury market is sort of the basis for other fixed income markets. And to the extent that is dislocated, those other markets are going to have knock-on dislocations. And we'll talk about them as we go forward. But the first thing the Fed needed to do was to get the Treasury market stable and operating as it should. So then now we're at, I think it was a Sunday night, March 15th. The Fed announced a number of measures. But specifically with the Treasury market, they announced that they were going to do purchases up to $500 billion a day. And then also in the MBS market, which tracks the mortgage-backed security market, which tracks closely the Treasury market, they were going to do another, I forget what the number was, it was around 200 billion or so in actual outright buying. And this was going to add to the Treasury, the Fed's balance sheet, which has now gotten to a very large number. So anyway, on the 15th, they announced that. And it had an impact, certainly. It had both an announcement effect and a real effect as people were able to put their treasuries back to the Fed. However, by March 17th, there was still showing pressures in the Treasury market. And essentially what happened was the Fed announced that this is the following week, March 23rd, the Fed announced that it was taking off caps. It would do whatever it had to do. There were no limits on what it would buy in the Treasury market to keep the market, as they put, we would use the amount necessary to ensure market stability. And this was kind of the first directive for the Fed, was get the Treasury market operating. First it was the repo market, then it was the Treasury market, get it operating in a stable fashion. So they also, just a couple other things they did on March 15th, they encouraged use of the discount window, which is where banks can go to put collateral to get dollar cash. And they tried to lower the rate so it had less of a stigma. As you're probably familiar, the discount window in the U.S. has a traditional stigma. You don't go there until you really have to, and it's a symbol that you're in trouble. They were trying to downplay that. But also, as this was turning out and it was becoming clear that this was a dollar funding issue and that, dollars were essentially being hoarded, just a kind of anecdote on the Treasury market. When I said the longer end, the longer tenor treasuries were showing spikes because they really were becoming much less, if not liquid at all, in the longer end. What was happening was everybody was moving their whatever cash they had into the closest thing to cash, which is very short-term treasuries. So Treasury bills were being bid up quite a bit. But the longer end bonds were having trouble. So this was an indication that cash was king and US dollars were king, which gets me into another piece. They also set up on March 15th, the swap facilities, the currency swap facilities with other central banks. And the Fed has, I think it's 5 of them that are kind of standing facilities with some of the largest central banks, Canada, the UK, the ECB, Japan, and Switzerland. And so they set that up and they raised the term of those swap lines. They raised the amounts that could be done at the swap lines. And then a few days later, realizing that this wasn't getting dollar liquidity to everywhere it needed to be, they stood up an additional 9 swap lines with an additional group of central banks, including Singapore, South Korea, Brazil, Sweden, Australia, New Zealand, Mexico, Norway, and Denmark. I think the intent there was to use this, and now we're up to 14 swap lines and central bank facilities, to use this to get dollar liquidity everywhere. Now, query, it certainly had an impact in those jurisdictions. And there's been some articles over the last couple of weeks about whether it's been effective to get it to other jurisdictions, which I think the intent was and the hope was that it would find its way there. Because I know, particularly as you move into some of the emerging markets and the growth economies, they're finding a lot of trouble getting dollars. Whether or not, and we talked about it, the Fed will do a lot. Whether they expand these swap lines to include some of these other jurisdictions is a bit of an open question. I'm skeptical because it does tend to be a very conservative, and that may be further than they want to go on this one. So anyway, that takes us through the initial stage, I think. What was happening? It was a move into cash. It was a move into dollars. Carter?
I just, before you go into the other, I'm trying to be cognizant of the audience and stuff. There's a couple of things that Rob's talked about that I'd like you to focus on. One is the Fed has now sort of become not only the lender of last resort, in some instances it's become the market maker of last resort. And so we're going to differentiate between when the Fed is lending and when the Fed is buying, because those are two different things. And it's doing both, and it's willing to do both, and that kind of thing. And then the other point that I wanted to interject here, because I think it colors all of this, is that the U.S. financial system entered this period in probably the best shape it had ever been in from a capital liquidity standpoint. But as you all know, we've completely rewritten the global rule book for banks over the last decade, and those rules have not been tested in a crisis. And so one of the things that we're seeing is that a lot of the problems that we said were going to occur are starting to manifest themselves. The primary one being, there's a lot of liquidity in the financial services sector, but it's locked up because they have to meet their liquidity requirements. And so what the Fed is seeing is it's having to provide liquidity that historically might have been provided by the financial services sector. So there's going to be some discussion taking place after this about, do we have the balance right? And we'll talk about that more, but I thought that was important as you go into these other programs for them to think of, as they think about it.
That's actually really, I'm glad you teed that up, Carter, because it'll be a subject for the next two pieces in particular as we get in to the commercial paper funding facility and the primary dealer credit facility. And something that Carter mentioned I want to highlight here is, the intent of the Fed certainly, and they do a lot of this activity through the primary deals. I'll talk briefly about that, but they do a lot of this. They expect the financial services sector to intermediate to the real economy. And to be very clear, as Carter said, the financial services sector, certainly in the US and I think globally, came into this in a very, very strong position. This was not a financial services sector created event, unlike arguably in 2008, which the core of that occurred in the financial services sector. It wasn't a liquidity event at the banks. It was a real economy event, albeit caused by the virus and the shutdown. So we can highlight a couple points around that in the next couple programs, but let me just talk. So we're in the middle of March. Other short-term markets, dollar markets, were being impacted. Most particularly, the commercial paper market in the U.S. was shutting down. And that's another key market and banks use it extensively for short-term, unsecured short-term funding needs, for day-to-day cash needs. Other non-bank institutions use it extensively, and that was shutting down too. And it was shutting down, quite frankly, for the same reasons that we were having trouble in the repo markets and in the treasury market. Yes, Carter.
It's important for the folks in Hong Kong. In the United States, 75% of capital is provided in the capital market. So these commercial papers markets are incredible. They're more important than bank lending. In the rest of the world, particularly Europe, those numbers are reversed, and 70 to 75, 80% of the lending happens on bank balance sheets. That's not the way it works here. So that's why this was really important. Sorry.
Right, and it certainly is. And when I say it was shutting down, it was shutting down. People were not able to find financing in the commercial paper market. They were having trouble rolling over outstanding commercial paper. And these were, AAA top-rated companies were having extreme trouble here. Go ahead, Carter.
One other thing, when that happens, when it shuts down, all those corporations have backup lines of credit with the banks. And so the other thing that was going on was, if you can't fund yourself in the capital markets, then you access your lines of credit with the banks, and everybody was doing that at once. So,
right, which puts stress on the banks and the banking system and all that. But anyway, what happened on the 17th of March, the Fed announced, and they pulled this out of their playbook from 2008, something called the Commercial Paper Funding Facility. And the title is very descriptive. And what's interesting about this, and this is significant for a number of these programs, notwithstanding that the Fed announced it on March 17th, they didn't get it stood up and operating until, in the case of the commercial paper vehicle, until April 14th. But these stresses were seen in the market before the 17th. However, the announcement effect was significant. And you started to see the commercial paper market start to open up. Obviously, maybe the impact of more stability in the treasury market and the dollar markets helped. But also, it was uncanny. They announced the program and the market started to open up a bit. Not usually, but a bit. So financing was available. And basically what this was through primary dealers, the Fed was going to buy commercial paper original issuance. The primary dealers would go to an issuer of commercial paper, buy it, and then pass it on to the Fed. And the Fed would put the dollars out. As well, on the same day, the Fed also announced something called the Primary Dealer Credit Facility. And this is, again, this was another piece of the puzzle that the Fed pulled out of 2008. But I think there's a real, and this goes back to the point both Carter and I were making, that this is a very different situation. The Primary Dealer Credit Facility, and I'll just quickly describe it, it's the primary dealers are counterparties to the Fed, and they can put virtually any asset to the Fed, and the Fed will give them cash for it. It's a lending facility, and this is collateralized, and there's a long list of potential collateral, including treasuries, but all the way down to some municipals, some equities, there's haircuts. It's very much like, and this is the way it was designed in 2008, it's a discount window for dealers, not banks. Notwithstanding that most of the primary dealers are associated with banks. But so they stood this program up, and the intent was that this liquidity was going to flow through the primary dealers to the folks who needed it in the real economy. And to Carter's point, what was happening was some of this, and the program was probably less effective because of it, the banks were limited in what they can do, and the broker-dealer as affiliated with banks were limited in the amounts they could do. Plus, with everybody moving into cash and the banks having to deposit that cash at the at the central bank, which is where they kept it, which impacted their leverage ratio, which then impacted the amount of activity they could do with the real economy. So this was all getting clogged up arguably on the balance sheets. And we heard from our members, from say our asset management side, who couldn't get a bid from some of the major primary dealers who saying, I'm done. I am completely used up on my balance sheet. I have nothing. And these were in highly liquid markets, in activity that you could always get bids on and offers on, and it wasn't happening. And to Carter's point, it was reactive to much of, and I think in this case specifically, the leverage ratio. Carter, you want to talk about the suspension of the leverage ratio?
Yeah, so
a key point.
So one of the things that the Fed realized was that they needed to give some relief. I don't know how much you're aware of this, but when the Basel rules were adjusted following the last crisis, the United States generally gold-plated all of the rules. And so we have what are called, we have a supplemental leverage ratio. So the Basel leverage ratio is 3%. In the United States, for holding companies, it's 5%. And for insured depository institutions, it's 6%. So all these gold-plated rules, we argued against them at the time, saying that's hardwiring these things in, and it won't be a buffer. You can't breach it. And so what we're seeing is the Fed is granting temporary relief by allowing you to deduct treasuries and cash on deposit at the central bank from the ratio. And so that's freed up, a significant amount of the balance sheet. The problem then, of course, is that exemption only goes through next March. So we've already been talking to them about that creates a cliff effect and we need to, have it taper off and that kind of stuff. But back to Rob.
Yeah, and that gets to my point that if you're going to expect the financial services industry to intermediate, you got to let them intermediate to get to the real economy. So let me just finish, and I'll move on to the next program and where the next stresses were. But the PDCF, the Primary Dealer Credit Facility, it was basically a repo on a laundry list of collateral, as I said, with the primary dealers. Query how effective that was. It was very effective in 2008 because there were liquidity problems at the various primary dealers. So the next, and now that moves from March 17th, we're now on March 18th. Other pressures were showing themselves in the money market sector, the money market fund sector, and particularly, and you look at prime money market funds in the US tend to hold commercial paper, treasuries. Yeah, Mark.
Rob, I'm just conscious of time. We got about 20 minutes left, and I don't know how much more you have to go through, but it'd also be good to leave some time to talk about what's going to happen in the future. So,
yep.
A really good.
There's really two more buckets. This and a couple other items I want to get to. Okay. So they established that all those assets I just mentioned are obviously assets we've been talking about that had struggled the week before. So they established a money market liquidity facility, which allowed banks to go and buy from money market funds some of these assets and then put them to the Fed. So it created liquidity where there wasn't liquidity before, where some of these funds were looking to get into cash. So that was the first stage of the programs, and it dealt with, a number of the stresses. I think I highlighted the particular markets where there were stresses, but the next set of markets that were showing stresses, there are two I want to highlight, and they really will get us the last two programs we'll talk about. The corporate credit market, corporate bonds, and the municipal securities market, which, well, we'll give you a little background on that, but that's kind of significant because the Fed has really never gone into buying municipal securities. But the corporate credit market was showing similar stresses. People were not able to raise money and float bonds in an efficient manner. That market was starting to shut down. So the Fed stood up or announced in late March, I think it was March 23rd, two programs. One was a primary credit corporate credit facility and a secondary market corporate credit facility. The primary would buy directly from an issuer, and in the secondary would buy, it's pretty self-explanatory, secondary market bonds in the secondary market. There were ratings requirements, there were tenor requirements on what bonds they would buy. But again, this had a significant announcement effect because they did not get this program, notwithstanding that it was announced late March, they did not get it up and running until early May. And the Fed has a lot of they got to get the pipes running. They've never dealt with this, and actually they employed, I think, BlackRock for these programs to administer and help them administer the programs because they don't have the expertise to do this. They don't buy these things regularly. They buy treasuries regularly. They don't buy these things. The other one I want to talk about, and then we can go to questions and what's coming next, is the municipal market. This, in the US, there's a massive market in non-treasury but government paper put out by states, cities, libraries, school districts. Some of these are very small issuers. Some of them are very large issuers. New York State, Illinois, these are very big issuers. California. But then you've got, a library authority in Utah that issues bonds. It's very significant. It's very significant for local services and state services. This market was also in late March, showing extreme stresses. The bid offers were getting wider and wider and wider. And some of it was attributable to worries over, and this goes into the corporate credit market too, worries over potential defaults, because as states were getting taxed in the sense that it was becoming more and more difficult for them to meet obligations because they were going to have to backstop all the activities, to ameliorate the COVID situation. So the finances in the states were not particularly good. And the Fed historically has avoided, because it's a very complex market. Two, they've just avoided getting in the market for U.S. municipal securities because they feel they shouldn't be in a position to be financing states and local governments. But given how important this market is, how important it is that firms be able, not firms, states and municipalities be able to continue to raise money in the capital markets, they created two other programs very similar to, or structured in a very similar way to the corporate credit facilities. There's a primary market municipal facility, and there's a secondary market municipal facility. There's requirements as to size of the entity they will buy from in the primary market, and there's limitations on tenor, and particularly in purchases in the secondary market. So this is a new area for them. They are in the process of setting that up. It's not operational yet. It had a very good impact on the municipal market. That opened up well. I think there was a balance. One other thing I want to mention about the last two programs, the last two buckets, the credit and the muni programs. One thing the Fed has done, and Carter is usually better at this, talking about this, and maybe he can come back to it. All these programs have been instituted with penalty rates in ways that they're really meant to be true backstops, not first stops, and somewhat limited in their market participation, unlike some of the programs that were stood up in 2008, where they were a little less than backstops. And I think there is some concern that who's making money here. And so the idea is, the Fed as lender of last resort wants to stay as lender of last resort. So they've imposed a penalty. And I would say, notwithstanding the penalty, again, there's the announcement effect, and notwithstanding that, some of these programs, they haven't been utilized that much. I just saw an article just before I got on here that I think the state of Illinois is the first one to tap or will be the first one to tap the municipal facility to a big amount. But notwithstanding that, the market has improved since the announcement. So that has, certainly helped. But I think there is concern that these not be, facilities of last resort or first resort. One other program I'll mention, it also hasn't operated yet, but it's very significant. It is another program that was operational in 2008, is the so-called TALF, which is a term asset lending facility. And it is really targeted at the asset-backed securities market. It's a very complex market. It's got a lot of different types of securities, includes CLOs in there, for example, and that's being set up. I don't know what the timeline is on that, and we're still discussing with the Fed, and we've had some comments for these programs, but let me stop there. I don't know, Carter, if you got any final...
Maybe, Carter, before you go, I'm just, conscious of time. I think we got about 10 minutes left. So obviously we've seen the massive fiscal stimulus was really fast, and as Carter said, got it into the hands of the people that needed it. And then we've seen all these Fed programs, which again, unprecedented, really have, basically gone into the repo markets, the treasuries markets, the commercial paper markets, and, start talking about credit and munis, and you stabilize that. But maybe a few questions here. I mean, how does the U.S. exit from this going forward? I mean, how does the Fed exit from this? I mean, the balance sheet has grown enormously. And then you've seen, as a couple of other questions, around the stock market is obviously very frothy. and it's recovered a good chunk of what it lost. And some of this we here is directly responsible from the fiscal stimulus of putting money into people's hands that they put into the stock markets. Where do we go from here? I mean, you talked about a liquidity crisis that we're getting through. Maybe we're going to get into more of a credit solvency issues as we get into the autumn, fall. Where do we go from here?
So let me try to answer that question and wrap up what Rob was talking about too. So essentially what they did is started with their playbook from 2008. They've now added some additional chapters where they've stepped in. They want to make more money for taxpayers on these programs because they want them to be backstops. On your question about the stock market being frothy, again, it's a little bit like when I gave you the background and said COVID is really hitting New York hard. It's not hitting the rest of the economy. The stock market in the United States, particularly the Dow and the S&P, are really dominated by Facebook, Apple, Amazon, and Microsoft. And if you think about those four companies, not only have they probably not been affected, they're probably growing. I mean, Amazon is hiring 100,000 people because everybody's buying everything online. So that's part of what's driving the stock market. The other thing on the Fed balance sheet, it started at about 800 billion before the 2008-09 crisis, and the balance sheet ended up at about 4 trillion. And Mark, they had started to try to wind it down. They didn't get very far before this crisis hit. And in the last 2 months, the balance sheet has grown another $3 trillion, and we sit just south of 7 trillion. So the unwind is something they've been thinking about for a decade. They haven't had a lot of success. But I heard it described as between the last Great Recession in 2008-09 and this, it's like we've had 2,000-year floods in 10 years. So don't know exactly how they're going to get out, but they certainly stand ready to do that. Another thing that I think is really important for you guys is one of the lessons that's been learned primarily at the state level, but it's getting through to the federal level too, is I don't think that if there is a resurgence of the virus in the fall, that there will be another shutdown. And I think it's highly unlikely that if this type of thing happened again, I think it'll become much more difficult to shut the economy down like we've done, because there's a realization that the shutdown may actually be worse than the virus, depending on where you're sitting. That's not to downplay the people that have died as a result of this virus, but we're seeing a big spike in deaths of people that are afraid to go to the hospital, and being unemployed leads to more suicides and, that kind of stuff. So you've got to look at the big picture here. And so let me stop there, so I'm not taking up all the time.
Yeah, and I just want to address Mark's question about how do you sort of, I guess, untether from these programs, which I think is where you were going from too, given how massive they are and they support across the market in a real umbrella fashion. I, quite frankly, don't know the answer to that, but I do think we're going to have to watch, and the Fed's going to watch carefully. Carter alluded to it over the next 6 months. But I've been talking to people, they're concerned about as we start moving into, and you're going to get this, corporate downgrades, what impact that's going to have on the market, actual defaults and bankruptcies. Carter mentioned that as well. I think that's going to be significant. What the Fed does there, Chairman Powell has been very clear, as we said at the outset, they will do anything. But at a certain point, to your point, if things get better, how do you calibrate your withdrawal from, the Treasury? They bought $1 trillion in treasuries in the last 8 weeks. How does that change over time? And like Carter said, they were trying to unwind the balance sheet before, and it wasn't particularly effective. So I don't have an answer for it, but I think it is a significant challenge. And it depends how long this event lasts, too. That's another thing.
We had a question mark about the riot. Do you want me to?
About the what?
About the riots.
Yeah. I think if you that would be good. Are they impact? It doesn't seem like it's impacting the stock market because it keeps on going up. But what do you think about that long term?
So first of all, I think on the riots there are two things going on, and I think this is the way it's starting to shake out. I think there are peaceful protests that are happening in a number of cities over problems with policing and race relations in the United States. But then there is looting that's going on. And I think a lot of the looting is just frustration and, quite honestly, it tends to just be young men. Doesn't matter what race. And I think that the peaceful protesters and the politicians and, civic leaders are trying to put down the looting. And so I think you have to sort of separate. I think the first order is to get that under control and then to try to deal with the issues that caused all of this. I suspect that what will happen, because we've seen this before, is that this will start to work its way into the political process because we are in a presidential election year. And so it'll become part of that debate. And I do think it will impact the election. It's probably likely to have a big impact on the people that are running, possibly Joe Biden's vice presidential selection, that kind of thing.
Okay, maybe a couple of last questions for me, last few minutes. You talked about the swap lines. You talked about, Rob said the reluctance of the Fed, potentially the reluctance of the Fed because of it being a conservative institution of extending those swap lines beyond where they are, which has already been a major extension. To the 9 additional countries over the original 5. My sense is that they must understand the need for dollars globally, and that the U.S. is, the U.S. dollar is a reserve currency. So I guess the sense that they must be just thinking that if we keep these swap lines open, if things get bad again because of whatever, we get another spike in the virus in different jurisdictions, that liquidity hopefully will flow out through the ones we have currently. But do you think if things really go wrong that they would consider stepping in again?
Well, again, it goes to the comments of Powell that they'll do whatever it takes. And if, the analysis points to that's whatever it takes, they may find themselves forced to go there in a sense. I do think to some extent we do get benefits. The U.S. gets benefits in having the U.S. dollar as the, global reserve currency. So it has to consider, global dollar funding over time. But again, they may get backed in a corner on that one if the current arrangements don't do what they want them to do, which is to get that liquidity around.
And
okay.
Can I add on that too, that
Yep.
What we've seen, Rob started going through this sort of day by day. Every time the Fed takes a step, it's a small step, but they keep walking. So all of these programs have been revised and expanded multiple times. So they are not afraid to act. They're just doing it conservatively. And so if there's a need for more, I have no doubt that they will do it. I think there are some countries that are never going to get a swap line, but we can talk about what's going on in Hong Kong, because the one thing I would say about that is it's bipartisan feeling in the U.S. Congress about how Hong Kong's being treated.
Yep.
So
I think that's for another webinar. We got 1 minute left. There are a couple of quick other questions. Do you think that Trump's election will be re-election campaign will be impacted in any way, negatively or positively, about the virus and about what's been going on in terms of the fiscal stimulus or the programs?
I would have to say yes. I think unquestionably, whether or not it will redound to the benefit of enough to the benefit of the Democrats. I don't know, but yes, it's got to have an impact. Carter, I don't know what you think on that.
I mean, he's the most polarizing president we've ever had, and it's kind of, as I've said before, when you think Washington can't sink any lower, they find a way to dig deeper, and you know, he's no exception.
Okay.
So.
Okay, we'll leave it there then, Rob and Carter. Look, thank you very much. A really excellent overview of what's been going on in the U.S. I think it really gives us a much better understanding of why the markets have been stable, and also why the stock market itself has been, as I say, pretty frothy. So thanks very much. I highly appreciate it. We may have you back, unfortunately, if things deteriorate again, but very, very helpful. And thanks again.
Thank you again for joining us today. Our next virtual event will be on Wednesday, June 10th, India Financial Markets Navigating COVID-19. This is again a free event, so please reserve your seat by either scanning this QR code on the screen or visiting our website, www.asifma.org/events. We hope to see you there. Have a good day. Thank you.